All
Okay.
right, so you're on, my friend.
All right. All right. Hey, welcome everyone to another weekly recap with Travis and I. Today we don't have a ton to talk about, so we're just going to kind of reiterate some of the things we talked about last week. And the reason we don't have a ton to talk about is because we're not doing a tremendous amount of trading. And so that's going to, before I cover the general market, I want to just kind of touch on a point with that. So when we trade on a weekly basis, we are generating income on a weekly basis in a lot of cases, but not in every case. So next week, I won't generate any weekly income because I'm not going to place any trades between now and next week. I may place some trades on Wednesday before Thanksgiving because that gives us there'll be a weekly really quick trade though, but because I can use the holiday for that time value decay to work in my favor. But it's just so to reiterate, when you cannot treat trading as a job. You need to treat it as a business, okay? And there's a fundamental difference. In a job, you show up every day and you get paid for showing up. In a business, you show up every day and there's no guarantee you're going to get paid. It depends on how well your business does. That's the fact of the difference between an employee and an employer mindset. So that's why you need to capitalize when you show up. That's why you need to be showing up so you can capitalize. So we did a lot of trading. You guys watch our weekly recaps. We've generated a good amount of income so that this week we can just sit back and spend time with the family, do other things that don't generate income, but we're okay with that because this is our business. We know there's going to be lulls in our business. So having said that, sound about right to you, Travis?
Yeah, that's perfect. Yeah, that's great.
Okay. And so kind of rolling right into the general market. So most of you guys saw that the market, pulled back significantly just like it did in February, only the major difference this time was it was the second time in a year, and it doesn't typically do that. We talked about it last week. We have stages we look at, and right now when we really zoom in, we're pretty much into stage 3 of 4 stages of a market crash, and we're getting really close to that stage 4. What's the matter, Travis? I heard you.
No, I was like, oh, wow. I didn't look at this first time looking at the charts. I'm like, oh, wow, we are in stage 3. I thought we were still in stage 2. That's why I was like,
yeah, if you looked, so we're dangerously into stage 4. So but yesterday and today were up days. So what does this tell us? Well, Travis and I don't try and predict what the market's going to do because we can't. We have no idea. I can't tell you what the market's going to do today or tomorrow. Today, it looks like it's going to be an up day, but you never know. It could turn into a down day at the last hour. But what it tells me is it doesn't know it's not quite sure what it wants to do. I said last week I wasn't real convinced that it was going higher, even though it was coming back from its pullback. So this week kind of makes me look good, right? Because it didn't go higher. It got up there and then it fell back down. But I only said that because of volume. I looked at volume and I looked at that 200-day moving average and then our stages that we use. I looked at those as well. And when Travis and I were talking about it, being the second really major pullback in a year is a big deal. So the other thing too is if you look at past bear markets, this is typically when we start to see a bear market, October, November timeframe. So we could be in for one. I don't know. So what basically this all leads up to, I'm not doing any trading. Usually when I can't convict myself to a specific direction or trade I want to do, then my conviction is to just stay out. It's the easiest way to not lose money, and that's my number one goal. Not to lose money. So kind of recapping some of the trades that I do have. I have my Macy's covered call is going to expire worthless today. I was going to sell another one, but Macy's is looking like it's rebounded and had really good earnings. Even though it dropped sharply before earnings, it's starting to rebound. So I don't necessarily want to sell a covered call unless I can at my cost basis, and I really can't. I'd make I'd make no money by doing it. So I'll just sit it out. I may do a vertical credit spread on it next week, a weekly one, but I haven't determined that yet. So we'll see. I'll let you know in the next recap. My AT&T cash secured put is going to be exercised today. I'm actually very excited, even though I'm being exercised at about $1.30 below the cost basis, but technically I'm even keeled because based on what I generated for revenue when I sold my cash secured put, my cost basis is around $31 and I think 60 cents, and it's at 31.30. So I'm only buying at a 30% loss, paper loss, if you look at it that way. But I'm really excited because I wanted to own AT&T. I looked at possibly doing some covered calls on it, but I'm not. I'm going to wait until after the holidays. Let's see what the market does. And I may even just wait altogether until January. So we'll see. That is all I have. Oh, I do have, I'm sorry. Yeah, my bad. I do have some McDonald's trades open, which are doing well. So they're at 67% gains. You can see them here. They have 14 days to them. So once those hit an 80% gain, I will close out of those. McDonald's it's going higher. I have to worry about 182.50. It's at 187.13. Some people criticize me for closing them out when it's nowhere near being assigned, but I take it. It's just the way I do business. I don't risk my $250 profit for 20 bucks. So that's it, Travis. I don't know what I did for time because I forgot to start my timer.
Oh, yeah, same here. Yeah. Yeah. And I was laughing because I'm like, I didn't criticize you, but I was one of the people who was like, well, that's what Peter does. I don't. But I'm like, now he's influenced me because I'm like, I've watched that. What would you say? $80? How much you didn't want to risk? How much for $20? I can't remember how much.
I didn't want to risk $250 for 20 bucks.
Yeah. I was one of those people who would until I lost too many $250. I'm like, I'm going to start doing what Peter does now and just close mine out early because I was like, it was not fun giving back all of that profit. So yeah, you have influenced me there, buddy. And that's actually moving forward next year. That's one of the rules. I'm like, I'm going to set up an automatic order to do that. I don't have to worry about it. My emotions automatically is going to close out all my trades at that level, that price level with 80, usually do about 80% profit.
80% is what I do. Yeah.
Yeah. So yeah, that's what I'm going to do. Okay. So let me go ahead and share my screen for you. I don't have much either. Looking at the time here. So tell me when you can see my screen.
I can see it.
Okay, great. All right. So what I'm going to do is just like Peter, how I handle the 4 stages. Peter talked about the 4 stages of a market crash. Now I want to clarify this because someone got a hissy fit last time we had this issue was 2015. Because the way I say it is, and it's true, every market crash goes through these 4 stages. Like you cannot find a market crash in history that has not gone through these 4 stages. Guaranteed every market crash will go through these 4 stages. With that being said, just because we go through the stages doesn't mean it will be a market crash. That's a caveat. I think some people took it as a guarantee. Oh, we're in stage 3. We're definitely going to market crash. And this was like in 2015, I think, when we had this, we went to stage 3. And then we didn't go to the market crash. And they sent an email all upset saying the 4 stages didn't work. I'm like, they're not guarantees. They're just visual aids. They're clues. So we can have a systematic way of watching what the market is doing so we know how to handle everything. So, I mean, you can look in history. Every market crash has gone through this, but just because we go through these stages doesn't mean the market's guaranteed to fall. No, these are just visual clues. Nothing is really guaranteed in the market, right? And so what I mean by that? Well, Peter talked about we're in stage 3 as of now. And that's why I was like, oh, what stage 3 means for me is I stop placing bullish trades that profit when the market goes up. So that indicates right now I'm about to show you, I have a lot of trades that profit if the market goes up. Well, we're in stage 3. I'm not placing any more of those trades. And I start to place trades that either benefit when the market goes down or I just do nothing, like Peter said. And we're around the holidays, so most likely I'll do nothing until after the holidays. And then we'll see where the market is from there. So that's what I mean. They're visual clues or aids that give me feedback on what to do. I'm listening to the story the market is telling me. It's falling down. And I have a systematic way to stage 1, stage 2, and each stage I do something. It's like a rule-based system. So stage 3, my rule is, well, I stop placing trades that profit when the market goes up. and I either sit tight or I start adding on bearish trades that profit when the market goes down. And so let me go ahead and share some of my trades right here. These are the trades. I was fortunate enough to be in a heavy cash position during this recent correction in October. So I was able to get in a few trades. I had no clue that these would work out. So I bought stock insurance, the same thing I've been telling people. I took risk during a time where the market was falling in price. I had no clue whether it was going to keep falling or not, and I didn't want to take that chance. So I placed a bunch of trades, but I also insured those trades. So if I was wrong, I wouldn't lose any money. And they wound up making money enough to pay for my insurance. So J&J is one. You can look to the right bottom right here where it says profit and loss open. That's up $706. That stock is actually still going up. Per the 4 stages of a market crash, I did add one bearish position. That's on Goldman Sachs. Current profit right now is 121. That's on a stock that's going down in price. So this is a visual proof for people who don't know that you can make money when stocks go down. Look at the stock. This is a 9-month chart of Goldman Sachs. It's gone down in price. Yet I have a trade here that's showing a profit. So that's why I always say stay encouraged. There are ways to profit and profit and thrive during bad times. You just have to have the proper education. All right. So next one here is that's the only bearish one. I need to add some more, but I probably won't because Thanksgiving is coming up. So I'm just going to sit tight. McDonald's is up $355. Okay, McDonald's and J&J are bullish trades, meaning that bullish means trades that profit when the stock goes up. Starbucks is up 202, but this is the second time I'm in this. I was in Starbucks earlier pre-earnings, and so let's pull up Starbucks real quick. Starbucks jumped up on earnings. I made a profit, I think, of about 1,200, give or take. I can't remember. All I remember was like, I don't want to risk losing this if it pulls back in price after earnings. So I cashed out. But when I cashed out, I left about $800 on the table because my trades hadn't hit max profit. I still had about $800 more I could have made, but that's greed. Sort of like going back to Peter. That's why I said Peter's influenced me. Previously, I would have held it. I'm like, there's no reason for me to get out. I haven't hit an exit signal, but I would have risked losing 1,200 in order to squeeze out an extra 800. So I was like, what's a smarter way to play this? Well, I got out and I got back in for, I think, $100. And if this trade continues going, if Starbucks continues going up, that 100 will turn into 800. So it's a lower risk way for me to capture that money I left on the table. And so far, I've captured about 200 of that. So I'll be looking to close out Starbucks here soon, probably because we're on stage 3. But I will wait until I get an exit signal, right? J&J, Starbucks, all these stocks are still going up. Why would I get out? I have not received an exit signal. I don't want to get out on the emotions because we're in stage 3. I wait until my stocks have an exit signal. Then I will get out. Right now, fortunate enough, they're still going up. MRK is another one. That's up 1,000. And so far you're adding up. Just when the market fell in October, I just happened to be fortunate enough to pick the few stocks that are going up. And I've made $2 or $3 grand while the market was falling in price. Verizon is another one that's up 1,000. And I have a couple more, but those are the ones I want to show you. So yeah, I'm making money, but I'm like, this money could go bye-bye because we're in stage 3. And so I really have to keep an eye on the market. I have to keep an eye on my trades and look to close those out to protect that profit. But even if I can't protect it in enough time and the market just drops, the floor drops out and it crashes dramatically, I'm still not worried because I showed you on the last recap the protective put, the stock insurance I have. And here's a secret. No, really, I hate that word secret because there's really no secrets. Really, it's just stuff you just don't know. But the reason I buy stock insurance for these particular trades, these trades are called defined risk trades, meaning that your profit and your loss is capped. All the trades I just showed you are defined risk, meaning that I only can make so much, I only can lose so much. They're not like call options. Call options, on Starbucks, I can invest 100, but my profit is unlimited. If Starbucks keeps going up, that call option will keep going up in price. Defined risk, if my profit is 100, that's the most I can make. I can't make any more. So these trades are defined risk. And the beauty of this is if you insure your portfolio, if you insure a defined risk trade with an unlimited profit trade, how about this? If you insure it, how about this? All right, I insured my trades. I insured my defined risk trade with the trade that had unlimited profit potential, almost, right? So my defined risk trade, I only can make 100, but what I insured my account with, I can make way more than 100, 2, 3, 4, 5. If the stock market keeps going down, I'll keep making money. And so, it's just a slick way to insure your portfolio. And yeah, I cannot say that adequately. So I'll just edit out all that. I'll just have to write it out so I can say it better next
Are you
time.
referring to your protective put? Is that what you're referring to?
Yeah, it's not unlimited profit. It'll stop if the stock goes to zero, which is unlikely. But the thing is, they'll have like 200, 300, 400% return on investment, where the income trades, they won't. You'll make whatever you're going to make. Like you can't, even if the trade keeps working out, the stock keeps going the direction you want, that trade won't make any extra money. Compared to the insurance, it will. And so when you're wrong, you can easily recoup what you lost because you insured it with the trade that wasn't defined risk. That's what I was trying to say. When you insure it with the trade that wasn't defined risk, your insurance can keep making money even after the stock does the opposite. And so that's kind of what I like to do. So
makes sense.
Anyway. All right, so that's all I have. We're not doing much. This is what we do during the correction. I'm looking at my accounts. Oh, I will say one other thing. I'm at time. Oh man, I've been talking for 10 minutes here, 9 minutes. Well, I can edit out some of that. But the one thing I do want to talk about, which worried me this morning, because I'm looking at my portfolio, as I just showed you, I'm making money. Even still, I have insurance. So if the market keeps falling, I'm fine. But I'm like, that's not the case for everyone else. So I wanted to pull up TLT, which is the 20-year bond, long-term bonds. And if you have a 401k, you most likely are invested in bonds right now. And so here's a 2-year chart. Bonds have gone nowhere, but let's look at the 9-month chart. This market has corrected in October, went down 10%. What did bonds do in that same time period? They went down. Aren't bonds usually a safe haven for people when stocks fall? Isn't that what people usually flock to? All right, look at your safe haven. It's falling in price. All right, start thinking about this. Looking at the close now. Don't wake up in the market crash and feel like a victim. Don't be a victim. The clues are right here in front of your face. You need to pay attention to it, right? Bonds are going down. Gold is usually a safe haven, right? Let's look at GLD. This is an ETF of a gold fund. Did gold rocket up higher in October during the correction? Nope. Gold is falling in price. So these are traditionally safe havens. Even Bitcoin, I don't even know the chart of Bitcoin, but I heard Bitcoin is crashing in price, right? So they said Bitcoin and cryptocurrency will be a safe haven when the market falls. Well, they're falling too. So all your safe havens that people traditionally flock to are also falling in price at the same time as the stock market. That's a clue. You need to pay attention to that. Because if the market crashes, don't be one of the people surprised that your account bleeded all this money and bonds didn't do what you thought they would do, because bonds are telling you right now what they will do during a market crash. That's why I said they're effective but inadequate. Those kind of protection measures that broke buy and hold experts say to flock to. Go to what was, if you study when options were created in the 70s, what they were initially created for, if you use them for what they were initially created for, like insurance, hedging purposes, then you will be okay. And the protective put option was originally created as a form of insurance. It's both adequate and effective. So it will go up when the market goes down, right? We could pull up, I didn't pull up a screenshot of my put options, but we could pull up one right now. You will see they're going up when the market is going down. So, and that's what they were created to do. So you want to flock to stuff bonds weren't defined. This is the point I'm making. Bonds weren't created to offset stocks. Bonds were created for income. So you want to flock to something that was specifically designed as a form of insurance. Gold wasn't created for insurance. Bonds weren't created for insurance. So why are these broke buy and hold experts telling you, oh, diversify with bonds and gold and all this? They weren't created for that, right? So they should be telling you diversify with insurance, because it was designed to actually go the opposite of stocks. So that's my final point. I don't have anything else because I'm going to start rambling on and getting all worked up. But Peter, did you have anything else to leave? I'm looking at my notes here. Did you have anything else?
I do not.
All right. Well, everyone, have a great week. We're not meeting next week. I keep having more and more to say. We're not meeting next week because of the Thanksgiving holiday. So we will see you in a couple of weeks. And then also, because we're in stage 3 of a market crash, I had one guy, Peter Lee, the Success Academy, and I was going to ask for your opinion whether you think I should open it up to replace him, because despite I swear, this is part of coaching. Please listen to your coach. Despite me telling people, look, don't stretch yourself financially to join. If you don't have a set amount, the program is just not for you at this time, right? Don't be desperate. I've never met a millionaire who got their, you can't broke your way to a millionaire, if that makes sense. Like, don't stretch yourself financially to join a program. Follow the basic principles. Save up money and then join the program when it won't be a financial burden. Despite me keep telling people over and over that again, we still have sometimes people will join. They just ignore you. They're like, well, let me rejoin when I have more money. I'm like, why? We told you not to join in the first place, but you didn't listen. So anyway, he gave up his spot. So I was going to ask you, what do you think if I should open it up to let one other person in to replace him? And more particularly because we're in stage 3, I was like, I at least want to save one other person from having an account bleed money. Okay. So what I'll do is, all right, so I'll open that, and I won't send a bunch of emails about it. I'll just open it. It's first come, first serve. Whoever gets his spot gets it, and then I'll close registration down. So we'll do that for that individual. And I already told you about next week. Yet we're not meeting next week. So, hey, you all take care. I hope this helped you understand and see what we're doing during corrections, how we handle it emotionally. It's nothing really for us to worry about. Our accounts are protected. We either have insurance or we are in heavy in cash. We kind of sit. We wait for the market to sort itself out. And as soon as we head into stage 4, you will see Peter and I start placing bearish trades that profit when the market falls in price. And so you'll see us making money as the market falls in price. So that's all I have for you. You all take care. See you in the next recap. All right. Bye-bye.
Happy Thanksgiving.
Yeah. Happy Thanksgiving for those who celebrate it. All right. Bye-bye.